Welcome back to Talk Tickers. So today's deep dive is into Prudential Financial, ticker symbol PRU. And our mission today is simple. We're translating all that Wall Street jargon into plain English, pulling the most vital data points from their Q4 2025 earnings call, and giving you the unvarnished truth.
Right, because we're totally impartial here. We're just looking at the facts and, what those facts actually mean for your portfolio.
Exactly. And honestly, if you're holding PRU right now, you're looking at a stock with a severe split personality. I mean, we're cutting through the corporate fluff today to look at the real financial engine here.
Yeah, and it's a fascinating setup. Because on paper, Prudential posted a quarter that just looks fantastic. But there's a massive international scandal that is really threatening to derail their forward guidance.
Which is wild. So let's just jump straight into the first pillar of our breakdown, the headline numbers.
Okay, so Q4 after-tax adjusted operating income came in at roughly $1.2 billion.
Okay, so that's what, like $3.30 per share?
Right, $3.30. However, that actually includes a $107 million one-time severance charge.
Oh.
So that's a 30-cent per share hit. If you exclude that severance charge, EPS was actually $3.60.
Wow. So that's a massive, 22% increase year over year?
Exactly, 22% jump. And for the full year 2025, their pre-tax adjusted operating income was $6.6 billion.
Which breaks down to $14.43 per share. Right?
Yep, you got it. And their adjusted operating return on equity, their ROE, it hit approximately 15%.
15%?
Yeah, that's up nearly 200 basis points from the prior year. Plus, they returned nearly $3 billion to shareholders over the year via dividends and buybacks.
Okay, wait, I got to push back on something here.
Sure, go ahead.
Because $107 million severance charge. I mean, I get the analogy, right?
Yeah.
It's kind of like paying off a high-interest credit card. It hurts your cash today, but it would frees up your budget tomorrow.
That's a great way to put it, yeah.
But I mean, cash still left the building. So a 22% jump in EPS and a 15% ROE sounds like a grand slam on paper. But is this core growth actually as impressive as it looks, or is this just accounting magic?
No, it's real. When we talk about after-tax adjusted operating income, we're stripping out the GAAP mark-to-market noise. This is the real cash generated by the core insurance and asset management business.
So the engine is actually working.
Yes. The U.S. business operations are genuinely firing on all cylinders. It proves the core franchise is highly profitable.
Right. But a 22% earnings jump only tells us what did happen. Not what's going to happen.
Exactly.
And that brings us to the biggest elephant in the room. Section 2, the story behind the numbers.
Yeah, and we should probably start with the good news before we get to the bad.
Hit me.
So the good. The U.S. business is just dominant. Their retirement strategies pulled in $40 billion in sales.
$40 billion, that's huge.
It is, and group insurance was up 11%, so that's over $600 million right there.
Nice. And what about PGM, their asset management arm?
PGM hit $1.5 trillion in AUM, which is up 7%.
Okay, so that's the good, but there's a flip side to PGM, right? The bad news.
Right. PGM suffered $10 billion in net outflows.
Ouch. 10 billion. Why?
It's mostly an industry-wide shift, moving from active to passive equity management. Plus, they had this low-fee fixed income withdrawal.
Gotcha. So that's the bad, but then there's the ugly.
The ugly is Prudential of Japan, or POJ.
Right, the misconduct issue.
Yeah. There was employee misconduct among their agents, and PRU announced a voluntary 90-day halt on all new sales in POJ.
Wait, really?
Yes, all new sales stop for 90 days.
That is insane. I mean, they voluntarily shut down their own sales for 3 months. That's like a major retailer locking their doors from October to December. Why take a $350 million hit on purpose?
Well, they're doing it to restructure compliance and compensation for their 10,000 captive agents. They call them life planners. And you have to understand why management is doing this. In the insurance business, trust is the only real product you sell.
I mean, true. If you lose trust, you have nothing.
Exactly. They are taking short-term pain, which is a projected 50% drop in POJ sales for 2026, just to prevent a total collapse of their brand in one of the wealthiest markets in the world.
But the cost of that is staggering. I mean, this scandal will cause a $300 to $350 million hit to 2026 earnings, right?
Yeah, it's about 5% of their 2025 earnings.
How does that breakdown look?
So it's $150 to $180 million directly from the sales suspension, then $70 million in one-time costs, which is mostly customer reimbursements, and another $80 million from the slow ramp-up once sales actually resume.
Wow. Taking a $350 million hit to fix a culture problem is a really bold move. But how does this self-inflicted wound impact the future of the stock? Let's look at what management said about the future in Section 3 management guidance.
Right. So PRU originally targeted an intermediate EPS growth range of 5 to 8% for 2024 through 2027.
But now,
because of the Japan scandal, they warned they will likely only hit the low end of that range by the end of 2027.
only the low end.
Yeah.
And that's assuming everything goes perfectly from here.
Which it might not. The 90-day suspension could be extended if they aren't satisfied with the compliance overhaul.
Oh, wow. So it's not even a hard 90-day.
No. And there's an additional $50 million earnings hit in 2026 expected from excess Japan policy surrenders.
Is that just driven by the scandal?
The scandal, yes, but also extreme yen volatility. And on top of all that, their legacy variable annuity runoff continues to be a persistent headwind of $10 to $15 million every quarter.
Man, that is a lot of headwinds. Was there any silver lining in the guidance?
There was. They expect over 200 basis points of margin expansion for PGM in 2026. And the recent corporate efficiency restructuring should yield $150 million in annual pre-tax run rate benefits by 2027.
Okay, so I have to push back here. On one hand, they are drastically improving their asset management margins and, cutting corporate fat. But on the other hand, they are openly warning investors that their EPS growth timeline is basically shot. So how is Wall Street supposed to price in an unquantifiable risk like we might extend the 90-day shutdown?
It's really tough. This is the reality of the uncertainty discount. Markets can price in bad news, but they cannot price in unknown news.
Right. The market hates uncertainty more than anything.
Exactly. The potential for further regulatory action from the FSA in Japan is hanging over them. Or, think about it, what if there's a mass exodus of their top-performing agents during the shutdown?
Oh, because they're forbidden from selling right now.
Right. If you're a top-tier salesperson and you're legally barred from selling for 3 months, you might jump to a competitor. That makes PRU's forward guidance incredibly fragile.
So we have record U.S. strength going head-to-head with severe international uncertainty. Which brings us to Section 4, the bottom line.
Yeah, it's a stark dichotomy. You have a highly cash-generative 15% ROE domestic juggernaut on one side.
And a deeply troubled international division that is bleeding cash and trust on the other.
Exactly.
So let me force the issue directly. If I'm holding PRU right now in my portfolio, do I panic sell? Or, if I've been watching it, is this a buy the dip moment?
Here is the final verdict. This is a hold, but with a giant asterisk.
Why not sell?
You don't sell because the dividend is safe. The U.S. business is completely insulated from this, and their liquidity is massive. They have $3.8 billion in cash.
Which is well above their target.
Yes, and they are actively returning billions to shareholders. You're basically getting paid to wait.
Okay, makes sense. But why not buy?
Because the stock is effectively dead money in the near term. You just do not buy into a major compliance scandal while the internal investigation is still fresh.
Right, because the regulatory fines haven't even been announced yet.
Exactly. You need to wait for the 90 days to pass. Watch the Q1 and Q2 calls to see if agent retention actually holds up. Until that uncertainty is resolved, your capital can find better growth elsewhere.
Got it. So just to summarize this deep dive, we've hit the headline numbers, the underlying story in Japan, the very shaky management guidance, and giving you the actionable takeaway, which is to hold, but don't buy the dip just yet.
All right, wait and see.
But I want to leave you, the listener, with a broader kind of unsettling question to ponder about your own portfolio.
It's a good one to think about.
It really is. If a massive, fundamentally sound, highly regulated legacy player like Prudential can uncover a scandal big enough to force them to voluntarily freeze their crown jewel international market.
Completely shut it down.
Right. Then what other financial institutions are currently sitting on ticking compliance time bombs? Time bombs that are just cleverly disguised as high-performing sales teams.
It makes you wonder.
It definitely does. So thank you for tuning into this deep dive. Keep scrutinizing the data, stay informed, and we will catch you on the next Talk Tickers.